studio in New York City. I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. A new report detailing that key bolts were missing on the door plug that blew off an Alaska Airlines jet mid-flight. The findings from the National Transportation Safety Board not placing the blame fully on Boeing for now, but Boeing CEO Dave Calhoun saying the jet maker will be accountable. We've got more details straight ahead.
An hour away from the close, and stocks are fighting for gains. Investors digesting more commentary from Fed officials who appear to put the Fed on track for rate cuts, but not as soon as the market initially hoped.
And it'll be a busy day continuing for earnings after the closing bell as we hit the halfway point of earnings season. Among the key names to watch, we'll have Ford, we'll have Snap, we'll have Chipotle, and we'll have full coverage and analysis. Let's get you up to speed on the market action right now as we look at the three major averages in today's trading, once again really being affected by individual earnings reports. All of that equaling not a huge amount of change on the index level. The Dow right now is up by almost 62 points, not even 0.2%. The S&P up just over 3 points, not even 0.1%. The Nasdaq down about 0.1% today. Material stocks coming back today after big declines yesterday. That group is leading the S&P 500 along with real estate shares as well. Tech, which was in the top position yesterday, is in the bottom position today.
All right, beyond the averages there, market action, Julie, let's talk about one big headline that just dropped here. The NTSB has released its preliminary report on the Boeing door plug blowout that occurred midair on an Alaska Airlines flight last month. The findings point to evidence that 4 bolts holding the door plug in place were missing at the time of the incident because there was no damage to the plug where those bolts were supposed to be, but stopped short of explicitly laying blame on Boeing. Shares of Boeing, let's check those out now, up about 1.5% nearly right here, Julie.
Yeah, and we had already known a lot of the details of this study from the National Transportation Safety Board because it had been leaked. Yep. There had been different discussions coming from inside Boeing and inside elsewhere. We did get a statement, courtesy of our Alexis Keenan, on this. Dave Calhoun, the CEO, saying whatever final conclusions are reached, Boeing is accountable for what happened. An event like this must not happen on an airplane that leaves our factory. And of course, Boeing has come under fire from many of its customers in the airline industry, saying that what happened is not acceptable and that Boeing, they have not necessarily been satisfied with Boeing's response. So now Calhoun really tempering his comments here and accepting responsibility.
Yeah, and in some sense, too, it's echoing what Calhoun has said before, too, right? Calhoun's been publicly already said, listen, Boeing is responsible for what went wrong, right? He said, we caused the problem, is how he put it. So to your point, he's sort of echoing here, listen, this is on us, it's on our shoulders. He knows he has work to do, Julie. To your point, I mean, some of those customers, both publicly and we know reportedly in private, have been very frustrated with Boeing about this incident.
Yeah, and in the statement today, Boeing again coming out and talking about specific measures that they are taking to improve the quality control at the company. They talk about layering additional inspections into the supply chain, collaborating with suppliers on production enhancements, among other measures that they are taking. So we'll see now that this report has come out. Presumably then there will be other sort of FAA and NTSB actions to be taken based on these formal findings. So I guess we will continue to keep everyone posted on what exactly that ends up being, those developments end up being.
Yeah, Calhoun is well aware you can't have customers like he has who are upset as frustrated as they are and saying so publicly, which is why in the statement he's talking about the kind of plan he says they have to have in place here to kind of strengthen quality and confidence of all his stakeholders.
Right, definitely. Well, moving on, let's talk about the Federal Reserve. Widely expected to keep rates steady through their March meeting. The Fed Bank of Minneapolis President Neil Kashkari saying today that we are still not quite there yet when it comes to year-over-year inflation data. So the questions still linger. When will the FOMC cut interest rates? How will it impact investors? We also heard from Loretta Mester, who said she's looking at 3 interest rate cuts this year. Jordan Jackson joining us now, JP Morgan Asset Management Global Market Strategist. Hey, Jordan, it's great to see you. So whatever we are looking at this year, your team did some interesting research on what happens to stocks when the Fed is cutting, particularly when the Fed is cutting and the economy doesn't end up going into recession. So talk us through what you guys found.
Sure. And it's actually, again, a pretty supportive backdrop for stocks. And so if you go back to 1980 and the 44 years over that time period, the Fed has cut rates in 14 of those years in which a recession did not occur. Now, in 13 of those 14 years, the stock market was positive and on average delivered a return of around 15.5%. And so if our base case plays out of zero recessions in the US economy this year, and for the Fed to start cutting rates in the back half of the year, that's a pretty supportive backdrop for stocks to perform well. We know equities like lower rates, and I think once the Fed actually starts cutting rates and easing up on restrictive monetary policy, that's going to bring back investor confidence, and I think that's going to allow a pretty nice rally in the market sometime in the back half of the year.
All right, Jordan, so bottom line, historically speaking, according to you guys, your research, this is a pretty good market backdrop. Within the U.S. stock market, Jordan, where do you see value right now? Is it large cap, mid cap, small cap? What do you find attractive?
So we do have a bias for quality. We have a bias for large cap stocks. When we look at earnings growth, where earnings are potentially going to grow from, we're in the camp of around 10 to 11% earnings growth this year. And that roughly being split between half of that coming from the Mag 7, but the other half coming from the rest of the market. Now, that would suggest that the Mag 7's got to deliver somewhere to the tune of around 20 to 25% earnings growth this year, which is a step down from the roughly 30% earnings growth that we saw last year, but still a strong number. Still, again, a backdrop that's supported for earnings. We have an economy that's strong. We have consumers that are still spending. And again, you've got that broader macro backdrop. Now, we do anticipate that growth is going to take a step down over the balance of the year. And so that's why you kind of lean into sort of large caps, be potentially playing a little bit more defense in an environment where growth is going to be slowing, but not collapsing.
And what's the risk that the Mag 7 doesn't deliver that earnings growth, right? Not just for those stocks, but then for the broader market?
Well, they account for a significant share of the market. It's somewhere close to around 30%. And so if we anticipate, let's call it low double-digit total returns coming from the market this year, you kind of need the big boys to do well. So there is risk. We're seeing some results being somewhat mixed in terms of earnings results when we look across the big players in the index. But we have to remember, these are good businesses. These are profitable businesses. And these are also businesses sitting on a large amounts of cash that are actually yielding them something. And so they're also investing very heavily in their businesses. A significant amount of research and development, as well as traditional CapEx investment. And that actually helps to improve the long run earnings growth potential. And so to some extent, you've got to look at not just 2024 earnings, but earnings for 2025, which are also expected to grow by another 13 percentage points, roughly speaking. So, again, I err on the side of being a little bit more bullish with being right balanced, right? But I think the Magnificent Seven will continue to be magnificent.
And Jordan, switching gears a bit here now, for bond investors who are listening, where do you see opportunities for them?
Well, I think tactically, and let me take a step back, I think investors need to have a 2 to 3 year outlook on interest rates, not a 1 year outlook on rates. The reality is it could be a very bumpy ride, and interest rate volatility has been very elevated. It almost seems common for the US 10-year to move 10 basis points in a given day, which is historically uncommon. So I think tactically, there is scope for rates to move higher. The market still has a little bit more to do in terms of pricing out rate cuts. I'm also a little bit more concerned about potentially supply side driven inflation, and that certainly complicates the march down towards 2%. So all that could potentially lead to a short-term move higher in yields. But I'm not calling for another 5% US 10-year. I think we kind of feel more comfortable with the 10-year back at around 4.25% to 4.3%. And that's where I'd really start to begin to leg into longer duration. Again, over the next 2 years, I feel pretty confident that the Fed is going to have cut rates. And we can argue till we're blue in the face how many times they cut rates. But inflation and growth are also going to have slowed down over the next 2 to 3 years. And that biases me for long rates to be lower. And this creates an opportunity for investors to start to leg out of all that cash and start getting into a little bit of duration.
And Jordan, with rates, if rates do stay in the 10-year in that 4% range that you're talking about, does that still imply tight financial conditions that then create risks in the market in commercial real estate and elsewhere? Or is this a level that, the economy can kind of cope with that without those type of knock-on effects?
Well, we've seen the economy, the broader economy, cope with it. Obviously, the housing market, the commercial real estate market are certainly feeling the weight of higher interest rates, and higher for longer could lead to another move higher in mortgage rates. We've seen mortgage rates now move back above 7%. Again here. And so, these parts of the economy can do well, but we just don't think it is a broader issue that's going to cause broader GDP growth and economic activity to come down. Again, we've seen the consumer remain resilient. We're starting to see the grants and subsidies via the CHIPS and Science Acts and the Inflation Reduction Act moving through private fixed investment. And obviously, there will continue to be businesses that are going to be investing around the theme around generative AI. And so certainly pockets will continue to sort of feel the stress, but I don't think it'll expand out to the economy just because the consumer continues to be in a good spot and earnings are inflecting back towards positive. So again, I remain cautiously a little bit more bullish for this year.
All right, Jordan, we'll take it. Thanks so much for joining the show today. Appreciate it.
Thanks for having me.
Moving on, shares of Palantir, they are surging following the company's strong fourth quarter earnings report that detailed the software maker's latest artificial intelligence advancements. Yahoo Finance's very own Josh Schaefer is here with more. Josh.
Yeah, Josh, investors seem to like the report, huh? I mean, when you take a look at Palantir's report, certainly better than Wall Street had expected. Revenue coming in above estimates, EPS coming in about in line. It seems like really what people are attaching to here, though, is what they talked about in terms of their AIP, a phrase I learned this morning reading through the earnings call. That means artificial intelligence platform, which I guess is rather intuitive. But it was mentioned over 50 times on their or about 50 times on their earnings call, and it really seemed to be what caught people's attention. They're saying AI can drive revenue in U.S. commercial revenue to nearly 40% growth in 2024. But zooming out here and sort of thinking about this move, I think it's interesting to think about investor appetite for AI, right? Palantir, when you look at the stock over the last year, has already ripped because of AI. We've seen the stock go up significantly, up over about 100% on the year prior to today's move. You can see now in the last year, I think it's up about 160% on the year. So you just wonder at what point are we maybe pricing in something that hasn't happened yet and might not come? And that seemed to be what some of Wall Street analysts were saying today. A Morningstar equity analyst was on this morning, and he noted that they were, quote, incredibly bullish on Palantir, but at the same time, we cannot rationalize Palantir's current valuation in the base case. Essentially saying, we like the stock, we think they're doing good things in AI, but maybe we've gone a little bit too far here.
Yeah, I mean, it is interesting. The other part of it, right, is that Palantir is sort of known as a government contractor. So anytime they talk about the commercial business growing, that's also part of the picture, although that can't really fully account for the sort of hype around AI, right? So what can we sort of imply and extrapolate kind of to expand on your point about the appetite for AI right
I mean, one of my favorite parts of earnings season is we can basically just circle these sectors of the market like AI and say, okay, let's take a look and see what stocks are going to move. I would circle a stock like Palantir. I would circle a stock like C3 AI, right, with ticker AI. These companies that, as NVIDIA has sort of set the market over the last year, the other companies that might have exposure to the market but maybe aren't quite there that have been soaring. So right now, I mean, it just tells me people aren't done buying the AI phrase yet, right? If you say AI, it seems to sort of work. I mean, you look at IBM had good earnings a couple weeks ago, but what was the thing we pulled out of IBM's earnings that rose the stock, right? Is they were talking about using AI, and people are still, they want to buy that dream right now.
I mean, look at NVIDIA. They didn't even report the earnings yet, and the stock has been rallying in recent days.
Up 5% yesterday on essentially, I mean, Goldman Sachs raising the price target to 800, so saying maybe there's more room to run. But the stock's at a record high, and all Goldman said was the AI narrative that we think is there is truly there. Like they didn't exactly say anything new, and people are still willing to buy in. I think it's interesting.
I like Brent Till over at Jefferies. We know Brent very well. But he actually went to a sell on Palantir, remember? And then today he's telling his clients, we were wrong, but we're not stubborn. So he went back to a hold.
Oh, I like
but to
that.
your point, Josh, as investors try to think about how much news is priced in, it was interesting Brent take it back to a hold, but stay on the silence because of valuation.
And the other thing I would say about Brent specifically too, in his take, we talked to him a lot on air. Brent's not like an AI hater or he covers all of these companies, and he's very willing to admit when AI makes a stock a buy, right? And when AI is going to be what pushes it all the way forward. So it'll be interesting to see if he comes up from that hold at some point and thinks that because Brent pointed out in his note, it was valuation right now that still has him kind of on the sidelines, and that's his key concern.
I love that, though, the flexibility. Thanks, Josh. All right, we're just getting started here on Yahoo Finance Live. Coming up, Tesla shares down more than 25% to start the year. We will speak to a longtime shareholder of the EV maker about the latest Musk drama and why he's holding on. Plus, Spotify stock jumps after strong guidance and user growth. We'll break down the numbers and dive into some of today's other top trending tickers on the other side. Plus, another big afternoon for earnings on tap. After the bell today, we'll hit the latest quarterly reports from Snap, Ford, Chipotle, and more. Stick around. We've got more Yahoo Finance coming up.
Checking in on a few trending tickers in today's trade. Shares of Eli Lilly, they are sliding a bit despite topping Q4 earnings expectations. At one point, today's stock was actually up 5%. You can see us trending lower now. So a reversal in today's trade. If you look at the print, Julie, Q4 earnings and sales beat. The forecast for 2024 sales also beat. There were some headlines, though, which were kind of worth hitting here, that Eli execs expressing some concern that a deal to expand Novo Nordisk weight loss drug protection could impact their own attempts to get medicines to patients. And I guess what they're talking about specifically, Novo buying contract manufacturer Catalent, which also produces some Lilly products.
Yeah, I mean, and Lilly said, listen, we've got contracts with them and they have to fill their contracts. So it's unclear if that's what's hitting the stock or if we have sort of a rotation factor today. Eli Lilly, of course, one of the best performing stocks of the year, right? There's been a lot made of the fact that it is now a larger market cap than that of Tesla. And so you do have something of a rotation out of the two outperformers, Eli Lilly and Novo, and into the other stocks that you see listed there, the likes of Pfizer or Moderna or J&J. So that's perhaps a little bit of what's going on as well. What the fact remains, though, that there is still huge demand being predicted for the weight loss drugs that Eli Lilly makes. For example, Zepbound, it says, its weight loss medication, it looks like that $2.41 billion is still what analysts are expecting from that drug this year, and it's newly introduced and already surpassing expectations. So it looks like the demand for these types of drugs is not going to be slowing down.
Which helps explain, as you noted, the move in this stock.
That we have
It's up
seen,
more than
yes.
100% over the last 12 months. It's up about 20% already this year.
Yeah. Pretty good run. Let's talk about another one here. Spotify, that stock is turning up the volume today.
Nice.
Not bad.
Very
Despite
nice.
missing on earnings, the streamer reported premium subscribers of 236 million in the fourth quarter. The shares up about 4%, although the shares were up more earlier in the session here. They did post a bit of a wider loss than estimated, even though revenue did beat here. But there is a lot of talk about the company's cost-cutting program being positive for it, and that gross margins are expanding. So that's something that analysts are pointing to as positives.
Yeah, they have been focused on getting leaner. Remember, they did announce those layoffs. I think it was around 1,500 people in December. So that's one point. They also did renew that licensing deal with Joe Rogan. I do like this note from Evercore telling their clients, great product, good business, great stock. So they looked over these results, they continue to rate this one outperform, target 285.
And one more number I just wanted to mention here as we talk about the premium subscribers. The company continues to see a growth in ad-supported subscribers too. Monthly active users there up 28% year over year to 379 million. So those are the premiums, but the ad-supported ones are also going up. And average revenue per user pretty much in line with what analysts had been estimating.
And one final one. Let's check out shares of DuPont. They are higher today. That is despite mixed earnings. This chemicals giant approved a new $1 billion buyback program. So that was part of the story. So Q4 profit beats. Looks like Julie adjusted EPS clocks in 87 cents. Street was closer to 85. Did get some capital return news, raised the dividend, announced a new share repurchase program. That always helps. Remember, though, this news comes after that sell-off we saw a couple weeks ago when they gave that Q1 profit warning. We talked about it at the time. In part of that point, they were talking about China weakness.
Right, exactly. And that's still a concern, but maybe that was a concern that got priced in to some extent. It looks like analysts are also pointing to the free cash flow as something that is better than estimated. In fact, Steve Tusa, longtime industrials analyst over JP Morgan, said that that's the lone positive, is that free cash flow beat expectations there. And so that's another thing that people are pointing to in addition to that buyback that's helping to some extent.
Stock's still in the red this year and over the past 12 months, by the way. We move on. Shares of Tesla, they're tanking to start 2024. They're down more than 25% now. And some analysts getting a bit nervous. The latest, the team at Daiwa Capital Markets downgrading Tesla to neutral with issues surrounding CEO Elon Musk piling up. Our next guest just says he's lightened his Tesla position substantially over the last 6 months. Joining us now is Ross Gerber at Kawasaki Wealth and Investment Management CEO. Ross, it is always good to see you. So maybe I'll start there, Ross. The team at Daiwa, as we mentioned, they downgrade Tesla to neutral, Ross, and they're telling their clients corporate governance concerns aggravating already tough financial conditions in 2024. So they're getting a bit cautious. What do you think of that take, Ross? You agree with it?
Yeah, I mean, there's just a list of concerns that's just one of them, and probably one of the least important of the concerns, considering the rapidly declining earning estimates and the lack of any transparency of what Tesla sales will be this year. And so, Tesla went from a very fast growing company with lots of potential to now basically, sort of almost like stalling and, really stuck, almost desperately trying to sell their vehicles now. And, it's really problematic because I think it's all self-inflicted. Tesla's a great company with a CEO who is, severely conflicted is the nicest way to put it.
So Ross, you guys have lightened your load in terms of how many shares you own, but you still own a lot of shares. So I'm just, what keeps the faith when you're looking at Tesla here? What keeps you in this stock? There's a big universe of stocks out there. So what keeps you in this one?
Well, you have to look at our situation. We bought Tesla at $3 a share. So for us, it's all profit. So every time I sell Tesla, for many of my clients, there's a tax consequence of up to 30% of that profit. So, that's something we have to really consider when we're selling the stock. Now, many of our clients do have it in retirement accounts like IRA accounts, which gives us a lot more flexibility. But it's really about what allocation is right for our clients. And Tesla was our largest holding for a very long time. But when, it really started with the anti-Semitic comments and we had clients calling to sell their Tesla stock who are now very happy because they sold more like at $250 a share. And, we continued to believe that Elon is eroding the value of the brand. And so we continued to sell the stock where appropriate to get it down to an allocation where we're at now, which is around 3% in our ETF GK, and for clients around 3 to 4%, depending on their situation. Now, we do have some, Tesla fanatic clients that, don't want to give up their stock, but it's hurting people a lot this year. And finally, the cost of Elon's behavior is really hurting shareholders. And it's really unfortunate because the reason we're holding the stock is the long-term potential of Tesla is immense. So, it's this catch-22.
And Ross, when you say that Elon Musk is eroding the brand, I'm just interested because a lot of people, Ross, when they think of Tesla, they think Musk. And when they think Musk, they think Tesla. I mean, they think of him as just foundational. Are you suggesting you'd like him to sort of exit stage right here?
No, I mean, really, it's just to shut up. I mean, he spends his weekend just railing on immigrants and the immigration issue, and he himself being an immigrant, and the perception of somebody who's intelligent who can get an H-1B visa, saying that people who don't have educations don't deserve to be in this country is really not a way to sell cars, especially in a state like California, its biggest market, where Tesla sales are down year over year. One must finally accept the reality that Elon's, white supremacist motivations is absolutely damaging the brand because he is equated to Tesla. But to pretend that he's not damaging the brand at this point is simply ignorant.
So, Ross, how do you fix it, right? Because, there have been suggestions. I know you yourself had sort of a short-lived run for the board at Tesla. There have been suggestions that the board is too close for him, that they're not sort of keeping him in check. But is there any realistic expectation that there could actually be independent or more independent board members added at Tesla?
Well, I think this is the pickle, and one of the reasons we've sold, a big chunk of stock was because I don't see how this works. Because, when I ran for the board, I realized very quickly that there was actually no desire for independence or any retail investment, representation on the board at all. I was like, this is definitely not a welcome wagon, And so, I got out of it, and now I've decided to sell some of my stock because I think that's what investors have to do when the company and the board isn't going to behave in the best interest of its shareholders, which is it's really behaving in the best interest of one of its shareholders and not the other 87%. So I think this is a real problem for Tesla. I don't see how the board can move forward in its current makeup because anything they do will be sued because essentially Delaware has ruled that it's not an independent board. And it's a requirement, that it is an independent board. So if they get new board members that are truly independent of Elon, this isn't going to work very well for Elon. And I'm sure he doesn't want that. And, I want to make it very clear. It's not my goal to be on the board of Tesla. I'm done with that. I have no desire at all. And nor is it my goal to see Elon leave Tesla. My goal is for Elon to leave Twitter and to go back to Tesla. He needs to get off Twitter and stop making his outrageous opinions known to the public on a daily basis and go back to his job as CEO of Tesla. And that's really what needs to happen. And so, if that doesn't happen, I think Tesla's drifting, in a place where I don't know where it goes until there's somebody on the board that actually wants to confront Elon and expects Tesla to get better results.
But Ross, you kind of know, though, when you invest with Elon Musk, he is a different kind of CEO, right? I mean, you know that when you commit capital to his companies, Elon isn't, Jamie Dimon, right? He's a different kind of guy. He's going to make his opinions known. I mean, you have to know that as an investor before you move in, right?
Well, I've been doing this for 10 years with Elon and Tesla. And, it's interesting, when he needed money and Tesla was on the verge of bankruptcy, he was very nice to me and everybody else who was giving him money that supported Tesla. Everybody thinks it's only Elon, and Elon obviously is the innovator of our time. But there were many investors like myself and my firm and several other firms that stepped up when nobody else would. And Elon was a different guy back then. So now that he's successful and he's the richest man in the world, he decides to use his capital to buy a social media app so that he can express, outrageous opinions on a daily basis. This is just not a good development for the company. It's just like Napoleon. Napoleon started off really well as well and had a pretty good run until he got involved with Russia. So Twitter is like Elon's Russia, and he's going to end up on Elba if he keeps this up. So I'd love somebody to try to talk some sense into this guy. He's certainly not listening to me.
Ross Gerber, maybe he'll watch this interview. We'll see, and he'll listen.
He probably will, for sure.
Ross, thanks a lot. Good to see you. Appreciate your perspective. Shares of Hertz bouncing back from a record low earlier today. The car rental company reported a wider than expected fourth quarter loss related to its electric vehicle fleet. With more, we're joined by Yahoo Finance's Pras Subramanian. Pras, speaking of Tesla, what can you tell us about Hertz?
Yeah, Hertz, they bet big on Tesla. Now they're sort of suffering from that big sort of buy. Back in 2021, they had a big marketing campaign, Tom Brady going all in on EVs, and now they're backtracking here because of the fact that they've suffered really steep repair costs for these cars when they do get into accidents. They're expensive to repair. The biggest thing, I think, is the residual value losses in the fleet. It's a big part of their business is selling off those cars after a few years. And if you're suffering huge losses in terms of value, they had to kind of stem that. And they decided, Stephen Scher, the CEO, was like, we need to do this now. Sold about a third of their EV fleet, 20,000 Teslas, said that they might have to do more if it warrants it. And, like I said, it's a kind of a fall from grace from like they once a big bet on EVs to now they still want to rent them out in certain markets where supply and demand are matched. And I think it's sort of speaking to where we are as a country with EV adoption, where certain parts of the country are into it and some parts aren't.
And another big name after the bell here, Pras, Ford, reporting results. What do you got we want to look at there? What's the focus?
Yeah, three big things, I think. Number one, profit outlook. We saw GM really have a strong they basically reinstated their pre-UAW 2023 strike outlook for adjusted EBIT. So we'll see Ford will do that. We're looking for a number around $11 to $12 billion there in full year EBIT. Looking at their EV game plan, they pushed back about $12 billion of spending last year. Are they going to keep doing that? Are they going to pull some of that forward? What do they see there with EV demand and that sort of thing? I spoke to Jim Farley about a month ago, and he said that he thinks that growth is still happening, just a bit slower. And finally, the hybrid pivot. They talk about how we're going to make every car hybrid if they can, et cetera. That's what they want to do. They want to offer you gas-powered hybrid EV. The only issue is that they just killed the Explorer hybrid because it wasn't that efficient. So you kind of got to make it work. It's got to make sense for the hybrid powertrain to work in the car and all that sort of thing. So we'll hear more about how they intend to do that.
Great roadmap. Thanks, Pras.
All right, we'll be watching. Thank you, Pras.
Thanks.
Appreciate it. Coming up, we're going to speak to an expert about how those in need of loans can use the high rate environment to their advantage. Stick around. More Yahoo Finance still to come.
Today, Treasury Secretary Janet Yellen testified before the House Financial Services Committee on the state of the U.S. economy. Now, during questioning with lawmakers, Yellen called commercial real estate a concern, but one that regulators were addressing.
The banking supervisors have also been focused on commercial real estate and are working closely with the banks they supervise to discuss ways to manage and work with borrowers who have problems. I'm concerned. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
And Yellen's testimony comes amid a steep sell-off of New York community bank shares, roughly 1 year after a series of regional bank failures, of course. And NYCB continues to sell off today. She was asked specifically, by the way, about NYCB and sort of demurred, didn't talk about it by name, Josh, but she did say we're monitoring the current banking stress carefully, but again, didn't mention that bank by name.
Yeah, I thought it was interesting when she talked about the commercial property sector, because basically her point was, yes, losses, it's a concern. There's going to be stress. She's talked about, interest rates, vacancy rates, loans coming due, but also kind of emphasized that line, regulators are on it, right? Focused on the issue. Basically, in many ways, echoing what Jay Powell told us on 60 Minutes. And in fact, used the same word, manageable. That's
right, and the market believes it's manageable. If you look at how bank shares are trading, the sell-off does seem to be largely limited to NYCB specifically. It's not sort of a broad bank sell-off, if you will. So that implies the same thing. By the way, we are going to hear from her later this week as well. On Thursday, she'll talk to the Senate Banking Committee.
She was also asked, by the way, about another subject we've talked a lot about, which is proposals to raise bank capital requirements. Didn't want to go there, but simply said, listen, I'm going to let bank regulators decide what's right on that issue.
Yeah, the banks themselves have been rather outspoken that they do not want that to happen. Well, as the Fed continues to hold rates higher for longer, it seems banks are holding steady, too, when it comes to loans. That's the finding of the latest Senior Loan Officer Opinion Survey. It's known in some quarters as SLOOS. It found around 85% of large and mid-market banks are leaving lending standards basically unchanged from the previous quarter after almost all loan categories saw weaker demand. Santander saw its loan growth decelerate in 2023, but it's now outlining how customers can use the high rate environment to their advantage. Let's bring in Santander's U.S. CEO, Tim Wennes. Tim, it's great to see you. Thanks so much for joining us.
It's great to be back with you.
So given the results of that loan officer survey, given what you're hearing from customers, first of all, just give us sort of a big picture look about sort of loan demand, what you're hearing from customers right now, what the overall sort of vibe about the economy is like.
Yeah, so what we're seeing on the consumer side, we still have the strength of the consumer. Employment remains strong, and they remain resilient and confident. As we've seen in our survey here, in fact, we saw the highest level of confidence among consumers and optimism that they're on the right track financially, with over 70% of middle-income Americans feeling they're on the right track to achieve financial prosperity, and 80% feeling like they're confident they'll achieve their prosperity goals in the next 10 years. And we had the lowest number of the year, 24% who were feeling financially insecure. So I think the consumer's in a good place. What we're seeing in terms of loan demand is some challenges around affordability in the areas around mortgage, auto, et cetera, with higher interest rates and still reasonably high prices. That is impacting loan demand for certain categories.
I'm interested, Tim, your perspective on the consumer is helpful, because as we kind of move through this earnings season, Tim, it's been kind of difficult to actually get a strong, clear read. Visa will say the consumer is resilient, but then you'll have a name like, Whirlpool report and disappoint. But your survey work showing a strength and resilience. When you survey those, Tim, consumers as well, what are the challenges they talk about? What are headwinds they're concerned about?
So number one is inflation, and that's been consistent. We do this survey each quarter, and each quarter in 2023, inflation is the number one impact or challenge to consumers. And 2 out of 3 consumers are saying that they're adjusting their spending patterns because of inflation, and that this is the biggest obstacle that they're facing. And we're seeing this in terms of some of our middle income borrowers having challenges with respect to all their loan payments. Inflation is causing them to adjust their spending habits, delay purchases, or make adjustments to ensure that they can get through.
Tim, we've been talking a lot about different automakers. We're waiting for Ford numbers after the close today. You guys have a pretty big auto loan business. What are you seeing there, and what is that telling you about what's going on with demand for cars?
Yeah, so we still see strong demand for vehicles. We're anticipating this year higher loan originations in 2024 than we had in 2023. And while there are some affordability challenges due to high car prices and interest rates, what we also see with our survey, 50% of middle-income Americans have put off buying a car over the last year because of affordability concerns. And so there is some pent-up demand. And 42% are saying that they're looking to purchase a car this year. So I think that there'll be some balancing out here this year in terms of the supply and demand equilibrium. We anticipate that there'll still be some modest declines in used car prices. We're seeing some inventory levels at dealerships moderately normalize, but still lower than what would be pre-pandemic normal.
And Tim, I want to get your thoughts on the commercial real estate sector as well. You know, we've just heard from Janet Yellen and we heard from Jay Powell. They both, Tim, basically said effectively the same thing. Yes, there's stress. Yes, they're watching it closely, but they believe it's manageable. Is that how you see it?
I do see it that way. And at Santander, I think it's important when you talk about commercial real estate to really break that down further. There are certain areas and property types in commercial real estate that are really doing fine, including multifamily and industrial. We're a large multifamily lender. We're one of the top 10 bank multifamily lenders in the country. We just made an investment and a partnership with the FDIC with some of the signature bank affordable multifamily properties in New York last month. So we still see the multifamily sector holding up relatively well, even though higher interest rates certainly impact cap rates. The office is a challenge in certain areas for certain properties and also in certain geographies. And that's something that we're certainly cautious about and watching very closely.
And Tim, just quickly, even in multifamily, because of kind of when the loans mature or when the borrowers are looking to refinance perhaps, is there any concern about that in the next couple of years?
Yeah, sure. For loans that were longer-term fixed rates that are coming up for maturity with higher interest rates, some underwriters previously maybe weren't stressing those borrowers or those originations. And so there certainly could be some pockets of challenge there. But I think a key driver there is going to be rents. And does occupancy stay high? And does rent demand stay reasonable? We're still seeing that in the core markets where we're doing lending. But certainly this is a watch item.
Definitely. We're watching it too. Tim Wennes, thank you so much. Good to see you.
Julie, Josh, thank you so much.
Take care. Coming up, YouTube CEO Neil Mohan unveiling the company's big bets for the rest of the year, including new AI advancements. We're going to dive into that and get you set for the closing bell when Yahoo Finance comes back.
Welcome back to Yahoo Finance. I'm Jared Blickery. Harnessing the power of options can be a tricky road to navigate, so we put together a guide to investing in options, along with some trade ideas for newcomers. And this is the latest installment of Yahoo Finance's Options 101, sponsored by Tasty Trade. And joining us here to discuss is Amy Wu Silverman. She is the RBC Managing Director and Equity Derivatives Strategist. Amy, thank you for joining us here today. I want to go draw everybody's attention to the Wi-Fi Interactive, where I have a couple definitions. This is basic stuff for options, calls and puts. You can go long a call. That is a right to buy a stock. If you're short, it's the obligation. And it's the inverse if we're talking about puts. But I want to move on to a topic that I was talking to you about offline. You said your number one recommendation to traders is that they have an idea of a catalyst in mind when there's with respect to a trade, and this ties into the idea of theta. Just wondering if you could break this down for us.
Sure, good to be here. Yeah, when I was thinking about when I first started in options, what was sort of the least intuitive part of it, it's this concept of theta decay. So, I think a lot of folks, when they come into options, they probably have a stock background. And in stocks, it's something you can simply buy and hold. So, the Warren Buffett idea of if it's something that is attractive value, you just close your eyes and then hopefully it has compounded a growth. Unfortunately, options don't work like that. You are fighting theta decay from the very first day if you are long options. And that's simply to say, if really nothing is going on in your underlier, that option is going to expire worthless at expiration. So theta decay is a way of thinking about the amount of bleed that you're going to get in that option if nothing happens, which is why it's really important to think about if something is going to happen in the stock that you've chosen for that option.
All right, now let's get to a couple of examples here. First, I want to introduce the concept of the covered call. We covered a couple of these last week, no pun intended. This is when an investor sells a call option at a set price and expiration date on a stock, and this is key that the seller already owns in an equivalent amount. So you own the stock and you're looking to place a trade against it, sell a call against it. And in this case, we're talking about Meta, and we're looking at selling the 485 strike price here, that call with an expiration of March 15th, while you own 100 shares of the underlying. Can you break down this trade for us and how you're approaching it?
Yeah, so the reason I chose Meta for this example is, in this case, when you're selling a covered call, you're doing the opposite of being long a call option. So when you're selling the call, instead of that time decay, that theta decay going against you, it's actually working in your favor. You're actually hoping that every single day, not much happens and you get to just keep that premium in that call option because you've sold it. You get that nice yield. And again, you've covered there, you're long the stock. So, this is not a naked short option position. In specifically the case of Meta, this is a company that just had earnings. And if you remember last week, it was actually up 20% on earnings, substantial move, really wild. And, hopefully if you've been long Meta, you're pretty psyched about that. But the other thing that we know is that a big event has already passed, and another big event, perhaps its next earnings is probably not going to come for another quarter. So this is a place where we would like not much to happen. And those 485 calls that you're selling is taking advantage of the volatility risk premium that's historically baked into almost all options. You're getting about a 1.5% yield, but again, that's for about a month in time. And again, you're betting that not too much happens. If it does, your stock gets called away at that 485. So, you do retain a little upside in this trade from where we were. I think the last I checked was trading around 456.
Well, let's take a look at this is not going to be a perfect reverse trade, but Uber, where we're looking to buy a protective put. So instead of selling a call and letting time decay work for us, we are buying a put here on Uber. And kind of explain the timing with this, because we're looking at an expiration of February 16th here.
Yeah, that's right. So this is a relatively short dated trade. So obviously, again, that time is not in your favor, but we do have two events that are coming up in Uber. The first is on February 7th. It's actually its earnings date. And then Uber actually has an analyst day too, where the company talks to different research analysts across the street who cover the company, February 14th on Valentine's Day. So you're really getting two events in the span of the time before that expiration, which is February 16th. So again, when you're long volatility, you've got that theta decay not in your favor. You really want some opportunity for something to happen. In this case, we have two potential catalysts which could drive volatility and hopefully protect your downside if those events are negative.
All right, those catalysts, the word of the day here. Got to thank you very much for your time. That will do it all for us in this segment. And now back over to you, Julie and Josh.
Thanks, Jared. Appreciate it. Well, YouTube's next frontier is apparently your living room. That's according to the CEO, Neil Mohan, who today published an annual letter unveiling the company's big bets for the rest of the year and announcing that YouTube TV now has more than 8 million subscribers. Alexandra Canal is here with more. Ali, obviously YouTube, very important here, a business, and doesn't get talked about as much with the other streamers, although that's started to change. So what are the takeaways here?
I definitely think we're reaching an inflection point where YouTube TV is going to be taken more seriously when we talk about a Netflix or a Disney Plus. And this letter really illustrates just the strength that YouTube TV has seen, and particularly when it comes to users watching YouTube from their living room. Globally, viewers now watch more than 1 billion hours on average. When you think about YouTube content, that's contributing to a surge of YouTube TV subscribers, 8 million subs, and anecdotally, I love YouTube TV. I use it as a cable replacement to watch my Bravo all the time. So I gotta say, thumbs up to YouTube TV. And then on the creator side, YouTube is really doubling down on that as well. They've paid out more than $70 billion to creators, artists, and media companies over the last 3 years. And they're going to continue to do that in 2024. AI was also a big part of this letter. They really want to harness AI to really leverage human creativity. So that seems to be the big thing that a lot of these companies are coming out with, saying, look, AI can help us, but we need to make sure that it's not hurting our creator economy and hurting the humans behind it. We'll see if that actually comes to fruition.
Yes, I'm very much wondering about that. Like if it's going to devalue human talent and creativity.
Right, there's a tricky balance between, propping it up or devaluing it.
All right, Ali, thanks so much. Appreciate it. And coming up, earnings season, we roll on. After the closing bell, we're going to break down the latest numbers from Snap, Ford, Chipotle, and much more. Stay tuned. More Yahoo Finance after this.
There's the closing bell on Wall Street. So let's do a quick check of the markets here as we close things out on this Tuesday. We've got all three major averages ending in the green after kind of flirting with negative territory for a while there. The Dow up 141 points here as we finish things out. The S&P gaining about 0.25%. The Nasdaq eking out a little bit of a gain for almost 0.1%. So interesting here to see all three majors in the green by the end of the day here. As we talked about, materials coming back today is at least part of the story of why things were up.
Major average in the green. Here's another one that was in the green. Check out shares of United Parcel Service. They are popping. It's after UBS upgrade that stock to a buy on the company's cost reduction narrative. So new fan on the street. Team at UBS says this one's a buy. The price target goes to 175. Bottom line, they say, Julie, UPS could keep reining in expenses. I think that was basically the crux of their thesis that, of course, UPS gave that disappointing report last week, said it was eliminating 12,000 jobs. This analyst saying UPS could cut more. Yeah,
which is interesting because they've already cut quite a bit in that announcement. I mean, 12,000 of their 85,000 management jobs was already the cuts that they did. That was aimed at saving the company more than $1 billion. So now the folks over at UBS raising their estimates for 2025 to $10.30 a share, well above of consensus, and they're looking at even further upside potential going out to 2026. All right, let's talk Symbotic. Those shares plunging after the company reported a quarterly loss. Its second quarter outlook disappointing investors, down by 24%. Now, this is a company that makes robotics warehouse automation software and other systems here. So you would think that there would be a lot of demand for this right now. It sounds like, according to analysts, there was sort of some lumpiness here in supply chain and in orders, and that's part of what led to the miss here.
Yeah, some analysts were saying, I mean, that was kind of the more, I guess, optimistic take is really this was just kind of lumpiness. They were shrugging off. I mean, the issue here was the forecast. It was Q2 adjusted EBITDA. They gave 12 to 15 million. That missed consensus. Also, the Q1 loss per share, it looks like, was bigger than estimated. So you could see the reaction in today's trade. Finally, let's check out Frontier shares. They are flying higher, nice, after reporting break-even earnings as revenue came fairly in line with estimates for the fourth quarter. So the budget carrier here, Julie, the reports, investors like what they see. Q4 sales beat, quarterly loss narrower than the street guessed. On the call, and that was important too, execs were talking about revenue trends improving and their expectations that they should continue to improve. And in fact, today, off that report, you saw a number of budget airlines actually moving higher, and today's trade sort of in sympathy with that. Yeah, there were some cost controls that the company talked about as well, and that was something that analysts liked. I just want to point out here just quickly, when we look at Frontier, remember there was a battle between Frontier and JetBlue to acquire Spirit. Yep. Frontier lost that battle. Although, as we saw, that situation did not turn out very well because it looks like that other deal is not going to be consummated. Still, though, they canceled that deal back in July of 2022, Frontier did, and it's still down more than 40% from those levels. All right, one to watch. Yeah. Major averages posting gains on Wall Street. Jared Blickery is here with a look back at the day. Jared.
That's right. Let's dive into the sector action. Two of the worst sectors from the last couple days are now the best. That's materials and real estate. They were responding to that surge in dollar and the surge in rates. That kind of reversed today. At least they're holding. That is rates in the dollar. Now, healthcare is in third place. And then we have industrials, consumer discretionary, and utilities rounds out the top row. And then in the bottom row, we have communication services and tech. Those are the two best sectors over the last year. Might be seeing a little bit of rotation or maybe a little bit of defensiveness. The AI trade, as expressed through NVIDIA, definitely faltering today. I want to show you a 2-month chart here with NVIDIA. In fact, let me dial it down to a 1-month so you can see this candle. This is getting a lot of attention today, kind of a hammer candle. You can see it's red and it's big and it's by itself almost in terms of the space above it. And this just points to the potential potential of a topping formation, but I'm a big believer that you have to wait until the next day to see how things close tomorrow and then get another candle for that pattern before we get too ahead of ourselves. But let me just show you what happened in semiconductor land. You can see not an entire sea of red, but AMD down 3.5%, Qualcomm just treading water there. ARC components, so disruption having a decent day. For that matter, running on totally different fundamentals is China. It looks like leadership there closer to maybe putting some support under stocks, but don't get your hopes up. Their backs are against the wall. Nevertheless, Alibaba up 5%, Pinduoduo up nearly 4%, guys.
Thanks so much, Jared. Appreciate it. Well, we've got earnings from Ford that are just coming out here right now, and it looks like we have a beat from the automaker here. When you look at what's going on with revenue here by the different metrics, as well as earnings per share. Earnings per share coming out at 29 cents, 13 cents is what analysts have been anticipating. As our Pras Subramanian told us earlier, what was hotly anticipated here was the forecast. And the forecast is better than estimated. The company saying for 2024 adjusted Ebit, earnings before interest and taxes, will be $10 to $12 billion. $9.24 billion is what analysts had been predicting. The company is also giving shareholders a little extra present here, a supplemental dividend of 18 cents a share for the first quarter here. So that also something that will likely drive those shares a little bit higher here. So beating last quarter, beating with that estimate. And I also want to talk about what we are seeing in the individual divisions for the company here, because that is also important here. Pro EBIT in the fourth quarter at $1.8 billion is a little bit better than estimated. So is revenue. Blue revenue, $26 billion, is also better than estimated here. And I'm also looking at the Model E, the electric division's EBIT loss. That is a little bit wider than estimated. So still expensive, the electric vehicle efforts here. I'm going to keep looking through here and see if we get any more discussion of hybrids, for example, because that's also something that Pras talked about that we're going to be watching.
Yeah, I mean, what's interesting to me is really the color we can get on the 2024 outlook, because that Q4 report was, of course, really impacted by the UAW strike. So I think the guidance is kind of really more even important than ever for this one. Also interested to get any more color on the EV business. Growth has slowed. We know Ford has responded. Remember last quarter they pushed out about $12 billion in EV-related investments. So it'll be very interesting to hear what they have to talk to there. And then, as you noted, color on hybrid, which we know has been stronger. And Ford has said, listen, they're going to push to bring more hybrids to the market.
Yeah, and also the company talking about the F-150 Lightning and the Mustang Mach-E SUV, both up year over year on the full year here. Although, as we talked about with Pras recently, the Mach-E in particular was seeing a little bit of waning demand. So we'll see if we get any more discussion on the call about that. That should be quite interesting to hear about that as well. Also interesting here, the chief operating officer talking about that they're working on correcting quality and cost issues here in 2024. In the statement, Kumar Galhotra, the COO at Ford, saying, we're seeing green shoots of quality improvement, including in our new product launches, with several important ones come this year. So that's going to be something. He also talked about landing $2 billion in cost reductions this year. That's the goal in areas like material, freight, and manufacturing. And we're just getting started. And as we know, that's what investors like to hear right now.
Yeah, I mean, look at that initial reaction.
Yeah.
Heading into this print, by the way, Ford was down about 10% over the past 12 months because there was these concerns, not just for Ford, but the broader auto sector about rates and slowing EV demand, labor costs. But the initial reaction there, strong in the after hours.
Yes, most definitely.
All right, coming up, the latest earnings from Snap and Chipotle are still to come. We'll have those numbers on the other side.
Snap just coming out with its numbers, down 19% in the wake of those numbers. So let's run through them here. The company's earnings per share for the fourth quarter actually beating estimates 8 cents versus the 6.4 cents that analysts had been estimating. However, revenue missed estimates, coming in at $1.36 billion, slightly shy of the $1.38 billion that analysts had been estimating. Fourth quarter EBITDA handily beating estimates. But let's move on to some of the forecasts here. First quarter revenue going to be at most $1.14 billion. Analysts were looking for $1.11 billion, but if you take the midpoint of their $1.1 to $1.14 billion forecast, it looks like that could be a slight miss. Fourth quarter active daily users at 414 million, above estimates as well. And then finally, here's the other headline that might be responsible for the drop here. First quarter adjusted EBITDA going to be a loss of $55 million to $95 million. The estimated loss from analysts was just under $33 million. So I know that was a lot of numbers to spit at you, but I think the key number here that's linked to the stock reaction may be that prediction for first quarter EBITDA losses wider than estimated.
It'll be interesting because it puts into. I mean, remember too, it's interesting since this stock has been on a rocket ship. I mean, since early November, it had surged really. It's something like 70% heading into this print, in part because investors had become more generally optimistic about kind of the digital ad market. You know, bulls like the fact they would talk about how this company's getting leaner and kind of meaner. You did see Snap just announce a 10% workforce reduction. I do think you're right. That Q1 adjusted EBITDA seems to be what the focus is on, and so we'll have to wait and hear what are the puts and takes in that metric.
Yeah, it's quite interesting, right? Because we did talk about how the company just came out and announced that big job cut that, you know, maybe people were bracing themselves for not great results. I mean, you were sort of halfway saying tongue in cheek, like the stock always moves so much on its report. And indeed, I'm looking at the past 1, 2, 3, 4, 5, 6 earnings reports. The stock was down. In 5 of those 6, it was down by double digits. So it does tend to move quite a lot after its earnings report. So we'll see. And I believe about 19% was the price move implied by options. So interesting that we're seeing it move in that 20% range. Let's dig more into these numbers now. Snap shares, as we've talked about, plunging some 24% right now after fourth quarter earnings. Scott Kessler is joining us now, Third Bridge Global Sector Lead for Technology, Media, and Telecom. So obviously a pretty ugly reaction here. What do you think is the biggest source of disappointment here, Scott?
Well, a couple things. Obviously, you mentioned the EBITDA guidance. I'd be curious to know to what extent the layoffs that you just touched upon are incorporated in that guidance, or if somehow those considerations were excluded. But nonetheless, I think that's a number that people don't necessarily want to see. In addition, if Snap is kind of in the midst of a recovery and rebound, you want to see more revenue growth acceleration. And the fact that they'll likely, it seems, get to double-digit revenue growth, while encouraging, perhaps isn't quite as much as some people were looking for.
And Scott, when you look across the digital ad market, you know, and you think about Snap, what makes Snap different? What kind of separates it, do you think, from its peers?
Yeah. So, Josh, what I would say about that really is one thing and one thing only, and that is historically this company, more than any other, has focused on brand advertising versus performance advertising. It's one of the reasons why they really had some issues early on, post-COVID, if you will, because there was this dramatic shift to direct response advertising, essentially associated with e-commerce. That's not how Snap was built. It's not how it was operating. And they've spent essentially the last year rebuilding the advertising technology and solutions to enable them to more effectively sell that kind of performance e-commerce advertising. But because of that historical orientation, it's really put them on the defensive, and they've spent a lot of time and a lot of money essentially re-engineering the platform for those capabilities.
I mean, it's interesting, Scott, because you do see growth in subscribers still, or users, right? Daily active users at 414 million last quarter is still up 10% year over year, which is not terrible, right? So is it just that they really need to wring more revenue from those subscribers, without spending so much.
Yeah, look, I would say not terrible is probably not a ringing endorsement. I mean, this is a company that, not a lot long ago was, really doing a great job when it came to all different aspects of growth. And I would say, at the top of the list was user growth. Look, I mean, barely in the double digits. When you look, for example, at a Meta, I mean, Meta is growing their user counts almost as strongly as Snap. Snap is a fraction of the size of Meta across a number of dimensions. And unfortunately, that's kind of the way that people are thinking about Snap is kind of, they have this very large user base in the hundreds of millions. And by the way, those are daily active users, not to be confused with a lot of other companies that are providing, similar numbers in terms of monthly active users. But the biggest single issue, I think, with Snap has been how do they go about monetizing those users? They've had challenges. Like I said, they're re-architecting the way they think about advertising. That's taken some time. I think some people have seen Snapchat Plus as kind of a silver lining, where they indicated just in December that they had 7 million paying users. Those are some positives, but at the end of the day, it's, is this company generating revenue and EBITDA and free cash flow based on those user counts and growth rates?
Are there levers, Scott, you think they could be pulling that they're not? Are there certain assets that you think are, under monetized right now, whether it's AR or Spotlight or Maps?
So you hit the nail on the head with that last one, Josh. I think a lot of people, including experts we speak to regularly, talk about Snap Map as being a top monetization opportunity. They haven't turned that on yet. I think a lot of people are waiting to see what they do along those lines, but it would make a lot of sense. I think one of the biggest challenges, though, in doing that is Snap has really been a leader and pretty outspoken, frankly, about how they think about data and privacy. And so is it potentially compromising of those tenets if, in fact, they're going to start monetizing Snap Map data with advertising? It makes perfect sense, but does it make some uncomfortable? That's possibly part of the reason we're seeing kind of some delays here relative to expectations of some.
And Scott, just briefly to broaden it out here, I'm looking at shares of Pinterest in the after hours too. It reports in a couple days. The shares are down about 5% in after hours trading. But, are Snap's problems unique to Snap? Or do you think there are some things you can extrapolate out to the broader sort of social media ad reliant sector?
It's interesting, right? Because I definitely think that people look at both of these companies as kind of, second or third tier players when it comes to digital advertising. And I would argue both of them have been doing similar things over the last, let's call it year and a half, 2 years in terms of pivoting from brand advertising to performance advertising. The difference, though, is that Pinterest seems to have done a much better job. And the reason for that, in part, is because of the alliance announced in the middle of last year with Amazon and the traction that they've seen there. We've spoken to folks who are very optimistic about that relationship and others to come, and think at this point, Pinterest may just be scratching the surface of what's possible. So it seems like they've kind of cracked the code on how to proceed from an advertising and monetization perspective, whereas Snap, it seems like they're still trying to figure things out.
Scott Kessler, great to see you. Thanks so much for that instant analysis there. Snap analysis, dare I say. Thanks so much, Scott.
Thanks a lot. Take care, guys.
You too. We're taking a look at shares of Chipotle now following the release of its fourth quarter results. The shares up by about 2% because we had a pretty broad beat here across the board for the various numbers here. First of all, let's mention revenue at $2.5 billion. That was pretty much in line with estimates. Big beat for earnings per share, as you can see there, $10.36 versus the $9.71. And of course, it's Chipotle, so we got to talk about comp sales. 8.4% increase there versus the 7.1% that was estimated. And it looks like they're going to continue to open new restaurants in 2024. They're targeting 285 to 315. A margin, by the way, also impressively 14.4% above estimates of 13.8%. Now, I got to dig a little bit further into the numbers here, but there were some questions ahead of time. What were they going to see in gains related to price versus gains related to volumes and traffic? Because Chipotle has pretty consistently been raising its prices. So going to dig in, and I'm sure get more on the conference call about that too.
Yeah, what's impressive too, just initially, is this stock had already been up a bunch. I mean, it was up about 25% since November. It was up more than 40% in just the past 12 months. And at least initially, we're popping here in the after hours. It's going to be interesting with margins beating like that. I want to hear more about the consumer, Julie, and when they're entering the Chipotle restaurants, what are they ordering? Ordering it like they did 6 or 9 months ago, or are they trading, for cheaper options? I think will be interesting to hear about.
Yeah, a little more color here that I'm seeing in the statement in terms of cost inputs, right? They talk about food, beverage, and packaging costs in the fourth quarter increasing to some extent. Higher mix of beef and inflation across the menu. They said higher costs for beef, produce, and queso. But at the same time, they said there were menu price increases that helped offset that. And paper costs apparently were down. So that's something that helped as well. So interesting to hear about the kind of what's going up. Queso going up, paper going down in terms of the costs there.
A lot of tailwinds to navigate there. That's interesting.
Yeah, definitely.
All right, fine. Let's get to VF Corp as well. They're reporting. Let's see what they did. So revenue here, Julie, Q3 revenue, that comes in light, $2.96 billion. Street was closer to $3.24 billion. Looking through the segments, outdoor segment, it looks like that's a miss relative to expectations. Same with active. It looks like it comes in a touch light, and work segment also looks like it's undershooting expectations. Adjusted gross margins, 55.3%, though. That is a touch better, it looks like, than what analysts had guessed would be turned in. Some commentary as well here. We have already begun to see the impact of our efforts, the company saying to right-size the company's cost structure, improve its inventory position, resulting in stronger than expected cash flow and expanded gross margin in the quarter. Part of this story, you can see, though, at least initially here, the stock is down. It's really a turnaround story here. You've got a CEO with a turnaround plan in place, try to turn around Vans, North American, but a lot of folks on the street are still on the sidelines, and at least initially here, investors clearly disappointed.
Yeah, I mean, it's amidst activist pressure. It's under activist pressure, I should say, from Engaged Capital, among others. And if you look at the numbers here, this is the 6th straight revenue decline that VF has had, and that revenue decline of 16%, as we said, is a bigger decline than estimated. Outdoor segment revenue, it owns Timberlands, down 13%, active down 21%, work segment down 17%. So there's no sort of signs of strength in any of those at this point. And I believe all 3 of those individual segments also missed analyst estimates.
Yeah, it kind of goes, I saw some analyst commentary heading into this print, and I guess it kind of goes to some of that commentary, which was, listen, cost cutting is one thing, but ultimately you do have to execute and you got to innovate.
Yeah.
Right. All right, Disney set to report earnings after the bell on Wednesday, and a big question on investors' minds, can Nelson Peltz succeed in shaking up Disney's board? To discuss what to expect from the parks and streaming giant earnings when Yahoo Finance returns.
President Biden still facing struggles with his approval rating, especially when it comes to the economy, even as things in the economy do seem to get better, including readings on consumer sentiment. Yahoo Finance's senior columnist Rick Newman is back. There's a lot to dig into here. But let's first talk about what you wrote about today, that maybe he needs a foil within his own party.
Right. So I've been dusting off my notebooks from 2020. I mean, we're starting the primary process here in 24. What was going on in 2020? It's worth going back. So on the Democratic side, there were a lot of candidates. There was not one guy. Biden was not even the front runner at the beginning. Pete Buttigieg won the first contest in Iowa. The next one in New Hampshire, Bernie Sanders won. Elizabeth Warren was second, and Biden came in third. So he had a lot of competition then. And think about how they lined up against each other. So Bernie Sanders, self-described socialist, Elizabeth Warren, pretty close to him. And then Biden running against them, he was able to position himself as the moderate running against the leftists, if you will. And people will remember some of these issues that we were talking about back then, healthcare. Bernie Sanders said Medicare for all. The government should run the whole thing. Biden said no. We need to leave most of the system intact. Let's just make incremental improvements to the Affordable Care Act. Taxes. Bernie Sanders, wealth tax on everybody. Biden, no, that's too complicated. Let's just push tax rates up a little bit. Student debt relief. Bernie Sanders, forgive everything. Elizabeth Warren, forgive everything up to $50,000. Biden didn't even want to forgive anything until late in the campaign, and he said, well, maybe up to $10,000. So Biden won in 2020 because he was the moderate. He doesn't have a Bernie Sanders to his left at this point. And I think you could actually say that Joe Biden is the Bernie Sanders of 2024 because, on the national stage, he is the leftmost Democrat out there. I mean, there are more leftist Democrats in Congress, but they're not running for president. It's just Biden by himself. So he's got nobody as a foil to say, I'm the moderate in the race.
Let me ask you, we were talking off camera, Rick, and here's my question to you. Is it really about the message? Or at this point, do you feel like it's actually the messenger? Like people just don't like Biden. More specifically, they just don't think he is up to this job.
So I've explored this a lot, and I've got a lot of feedback on stories from people who tell me, here's the problem. You guys on the East Coast, you talk about how the inflation rate is coming down, but prices are still up 20, 25%. Food prices are up 25%. And that's true. I mean, food prices are up by more than incomes during Biden's presidency. Rent is up by more than incomes during Biden's presidency. So even though this problem is not getting bad, it's getting bad at a slower rate than it used to be. People still feel pinched. I mean, I think what Biden needs for people to feel better, I think he needs the price of hamburger to drop by $2 a pound. I think he needs the price of cereal to drop by $2 a box. Eggs need to come back down. And people say, energy was cheaper under Trump. Look it up. Energy actually was cheaper under Trump. Gas prices are in a fine spot right now in the low threes, but they were cheaper. They were lower under Trump, and people remember that. So, the trend is in Biden's favor. Some products are actually dropping in price. There is actually a little bit of deflation in goods, not in services really, but in goods. The economy looks like it's going to stay strong. Stock market rally helps. But it's kind of like a race to see what, by the time we get to November, will people start to feel these improvements in ways that are going to help Biden by November or not? I mean, it certainly seems like it's overdue, but there are a lot of people out there just saying, look, my pocketbook's hurting.
And there's nothing he can do about that, right?
He can't. This is why it's really not.
Like, he's not going to make your hamburger $2 cheaper.
It's really not about messaging, okay? Because Biden, no president, Obama tried to do this and he got creamed in 2010, I think it was. When you try to tell people that they should feel better about the economy than they do, they just think you're out of touch. James Carville actually said that on one of our shows recently. You can't force people to feel better than they do. You have to get them to understand that you feel their pain, to borrow Bill Clinton's famously empathetic way of putting it out there. I've seen some analysis among Democrats saying Biden and his team, they are still living in this like urban elite bubble where they're talking about issues that appeal to college graduates in cities, and they are just not thinking about working class voters. There are 105 million working class voters in the United States. They will determine who wins the presidential election in 2024. And a lot of Democrats say Biden is not paying nearly enough attention to them.
All right, we'll keep watching. Rick, always good to have you on the show.
You guys.
Thank you. We move on. Disney sending a message to shareholders today. Back the company, not activist investor Nelson Peltz. The company launching an unconventional video complete with a talking duck and movie characters, calling on investors to toe the company line, and CEO Bob Iger.
Remember, it's important you vote only for Disney's 12 nominees using the white proxy card. Do not vote for the Trian Group or Blackwell's nominees. Voting this year is critical, no matter how many or how few shares you may own. Professor Ludwig, what should the shareholders do with their blue and green proxy cards?
Yes.
Oh, he's on the phone.
I do not need the standard warranty.
Well, shareholders may simply discard them. Please do not use the blue or green proxy cards.
Another difficult question for the professor?
Thank you, Professor. I think our shareholders are now well informed on how to vote for their board.
All right, it comes as Disney will report earnings tomorrow, and all eyes will be on streaming profits and cost cutting as the company announces a password crackdown rollout. Let's bring in Robbie Whalen, the Wall Street Journal's Disney reporter. Robbie, it is good to have you here on this day. Listen, so Disney earnings on deck. Lots of drama, Robbie. Listen, activist investor Nelson Peltz, he wants seats at Disney. We just heard today, Robbie, from Blackwell's Capital. They're urging shareholders, listen, support our candidates. I don't know if you heard there, Disney's response. Help us just make sense of this, Robbie. How do you think this plays out?
First of all, I got to say, I love the Professor Ludwig von Drake video. I think that's some real classic Disney maneuvering there. Although I do wish they'd done an original cartoon instead of kind of doing like video clip art for that. But a very lighthearted spirit. It shows you that they're not, they're trying to project an image of not being super, super worried about the threat posed by Nelson Peltz and other activists to make changes there. But how to make sense of it is this. Bob Iger came back just over a year ago to run Disney for his second stint as CEO. And at the time, everyone rejoiced. They thought that this was a company that was going to turn around in short order, get back on the right track, improve its finances. And what's happened is that the share price just has not reflected that positivity. The positivity that workers felt when he returned, the positivity that Hollywood kind of felt when he came back to his perch. It's just not shown up in a meaningful way in the stock price, which is still down by about 40 to 50% from where it was 3 years ago. So when that happens, and when you don't see those kinds of results that you're expecting and hoping to see, it's perfect conditions for activists to come and try to shake things up, make some changes on the board. And that's what we're seeing right now.
Robbie, we just got the news reported by the Journal and others that Fox is teaming up with ESPN and Warner Brothers Discovery to create a joint streaming platform to share sports assets. Is that what investors want to see?
I would only correct you by saying that it was first reported by the Wall Street Journal, my very talented colleagues. I'm incredibly proud of them for getting this huge scoop, which is revealing what seems to be the big ESPN news that everyone in the media world has been chasing for months and months. I mean, we've known for almost a year now that ESPN is looking for strategic partners. We're trying to disentangle Disney's fortunes from the fortunes of the cable TV business, because that business is, as Bob Iger put it in an interview when he was out of the company, falling off a cliff. And so we saw this last year with the Charter fight, where Disney got into a fight over carriage fees for Charter. The cable operators are saying it's too much to pay for these channels, given that we have our tons of people cutting the cord every year, and so there's this massive kind of tension between the old way of doing business in media and in Hollywood and the new way of doing business. So we see it in theaters too. People aren't going to theaters as much, so you've got to make content for streaming. People aren't subscribing to pricey cable bundles as much, so you've got to offer them sports content and other live content on streaming services. And the problem there on sports specifically is that rights to broadcast sporting competitions have gotten incredibly expensive in recent years. We've seen some major moves, Apple getting into the MLS, Amazon a few years ago getting into the NFL, and all of these new entrants into that market just drive up the prices for those sports rights. And so what we're seeing right now is Disney, Warner, and Fox kind of trying to band together to sort of push back a little bit on that price setting that the sports leagues have really kind of taken charge of. And it's going to make things easier for them to sort of bid on packages if this deal goes through, that is.
And Robbie, I'm interested too, these activists that we talk about kind of surrounding Disney right now. Is part of the issue, Robbie, that you hear as you do reporting, that they hear Bob Iger talking about potential strategic shifts and moves, whether it's his comments about traditional TV or, equity stakes in ESPN, but they're frustrated that, he's talking, but there's no follow through, that he's not acting on those yet?
I think it's fair to say there's been some frustration with that. I mean, he clarified recently that a lot of his process involves sort of sending out trial balloons. He thinks of an idea of something that the company might do to kind of change things or improve things, and he talks about it in public. Doesn't mean he's necessarily going to do it. And I think that is a double-edged sword, right? Because he can kind of, hang a for sale sign, for example, on the linear TV networks and see what kind of interest he gets. Last time he did that with the linear TV networks, he got a $10 billion offer for ABC from Byron Allen. Didn't work out, but at least he knew there was a market for it. The other side of that, obviously, is that when people like Nelson Peltz, activist investors, or people who are concerned about the company's future and don't think that things are going the right way, they see that and they think, well, here's a guy who's all talk and no action, and none of the sort of things that he could be doing to right the ship at Disney is he actually doing. And so it's a little bit of a risky game, but it's one that we've come to be accustomed to when it comes to Iger and the way he floats new ideas.
All right, a lot of drama. Robbie, thanks so much for joining the show today. Really appreciate your time and insight.
Thank you for having me.
And coming up, we're going around the horn and checking in on some of today's top trending stories. Praz Subramanian, Alec Now, and Josh Schaefer are out on the newsroom floor with what to watch. Allie.
Hey, Josh. Well, Adam Neumann is trying to get back into WeWork. He wants to buy the company he once co-founded, but how legit is his interest?
And the big game is just days away. We'll break down how the Super Bowl is setting the tone for the consumer volume recovery. We'll have all that next, coming up after the break. Hello and welcome back to Yahoo Finance's group chat. I'm Josh Schaefer along with Pras Subramanian and Alexandra Canal. And today we're kicking things off with a potential bankruptcy buyback surprise. The co-founder of WeWork, Adam Neumann, is looking to purchase the company he once founded back. According to multiple reports, Neumann, who was ousted in 2019, is seeking to buy WeWork out of bankruptcy alongside Dan Loeb's Third Point. This, according to multiple outlets, citing a letter Neumann's lawyers sent to WeWork. So, Pras, it seems like Adam Neumann wants back in on the company that he basically was ousted from in 2019, but he got $1 billion when he was ousted, so he probably has a little bit of money if he wanted to come back and sort of roll the dice again with WeWork.
I mean, I saw Neumann and Dan Loeb, and I thought that was the strangest bedfellows I've ever saw in my life. Like, it's not really, Dan Loeb isn't really Neumann's kind of guy, and vice versa, but he must have seen something in the deal that he liked, and if you're Adam Neumann, you got that exit of over $1 billion, and you're going to come back and possibly buy his company out of bankruptcy for pennies in the dollar. And for Dan Loeb, this is the distressed asset if I've ever seen one. He's probably going to get a good deal out of it too. So it's really a win-win. But it's just so funny to me that these two guys are coming together at the kind of.
And I think a Third Point spokesperson had told the Journal too that they're not necessarily definitely in on the deal, but they had reviewed it. So it's not. And this isn't a deal that's been made, too. So just to make that clear, it's not definitely.
They're working on it.
Right.
Yeah.
It might be something that comes to fruition.
I'm just surprised Adam Neumann would want to do this. I feel like he was very much disgraced at the end. So maybe that's why he wants to rewrite the story, save the company. And I guess when you're a co-founder, it's something you really want to be back a part of.
He was all in. I mean, we got to remember community adjusted profit or whatever it was.
Yeah. I mean,
it'll make a great movie.
It will bring us season
Part
2 of We Crashed on Apple
exactly.
TV Plus. Great show.
Yeah.
But it sort of brings the larger question too, I think, that a lot of people have been wondering is why hasn't WeWork worked in the current work environment? And I wonder if that just brings that conversation back up, right?
Maybe
Rented
with
office space seems to make
work,
sense.
Hybrid work. I mean, we've definitely seen a resurgence of that over the past year or two, that perhaps there is another way that this company can operate in order for
Seems
that
to be
make
plenty
sense.
of people that only want an office 2 days a week right now.
Right.
Maybe in a post-COVID world, this is the right time for WeWork. So
True.
We'll see. So another thing, with the Super Bowl just around the corner, I've been looking at which stocks may be a good bet. Well, Bank of America today listing a few big names they expect to see a boost as consumer stocks up and start buying. Well, basically what they're saying is that a lot of the big brands use the big game as a way to sort of jumpstart some messaging, show you some new branding. And some of the stocks that these companies really that BofA is really high on was beer companies in particular, Bud, Molson Coors returning with Coors Light in Super Bowl. Bud has, I think, 3 different ads in Super Bowl. Constellation Brands, not so much there, but they kind of launched a lot of their sports marketing with beer stuff. So seen a lot of that. Staples names too. Makes sense.
To me, it's interesting. They really highlighted beer in that research note from Bank of America, and it makes a lot of sense when you think about the story of Bud Light that we've talked about a lot over the last year and sort of making your pitch back to your general consumer base. We know the Super Bowl has a giant audience. It also has a giant audience of people that drink beer and watch football. It's the perfect moment to make your pitch again, whatever their sort of big rebranding pitches are, right? To have a creative ad.
Those are the ads that stick out to me too.
Yeah, those are the ads that stand out, and you bring sort of people back. Maybe we get the Clydesdales back for Budweiser.
Sure.
Those horses were always a hit. I don't know, but something like that when you have sort of your target market audience all watching.
Especially when Bud Light and that brand has really been under scrutiny heading into this Super Bowl, so we'll see if that could do anything. But also, I caught my eye on a separate story about how the Taylor Swift effect could perhaps be entering the ad market with companies like L'Oreal, Elf Cosmetics. They've never submitted ads into the Super Bowl, and now they are going to be for the first time. So perhaps the notion is that with more female viewers watching the Super Bowl, they want to get in on the action. We also saw Dove. They haven't been in a Super Bowl for 18 years. They're coming back for the first time. So beauty brands, health and wellness brands, perhaps because of the female watcher, that's definitely increased. The NFL has said that. Maybe now's a good time.
You know, I had always thought that there was also kind of a split audience, or like a lot of women would watch the games. It is a big event to watch a lot of people.
It's totally an event.
But I think they mentioned this, Gen Z or millennials, right? More millennials might be, or sorry, Gen Z might be kind of attached to Taylor, and maybe that's why they're watching, maybe Gen Z women are going to watch the game for the first time, perhaps, and that's why these brands are hopping on.
And if you're getting women to be watching any football game, it is the Super Bowl, right? Like people want to be part of that water cooler moment, that conversation.
And how many times have we talked recently about how Gen Z is putting on more makeup and buying more makeup, right? A lot of those companies you just listed were makeup companies. If you're thinking you're going to get the Gen Z audience here, that's your market that's starting to come in, feels like a smart play. Yeah. The other thing I'm excited for, I feel like we're just on Super Bowl ads now.
Oh, yeah.
And the other thing that I'm always excited for is the brands that you haven't heard of as much, or even I would say a Dove that you've heard of, but like putting a name to a brand is something a lot of marketers have talked to me about in the past when it comes to sports advertising. It's why you see an insurance company like Acrisure Stadium going out and replacing Heinz Field for the Steelers Stadium, right? The value add you get, or what GoDaddy used to do with Danica Patrick, with the value add you get when you're a little bit lesser known brand and you tie yourself to the Super Bowl, you tie yourself to something that has Taylor Swift involved, feels like that's pretty big.
Well, you mentioned Taylor Swift, and real quickly, this was a crazy story. There's going to be a Swiftonomics class, University of Kansas, to basically teach the economic impact that Taylor Swift has had on the NFL, which is crazy. And like we were just talking about, the viewership numbers, now she's going to be in the school books, guys. She's already in the record books. Now she's in your textbooks, you know?
It's funny in this article, they talked about how people are interested in Taylor Swift. Maybe they'll be interested in economics now. I don't know about that, but it's...
Hey, he talks about the Taylor Swift economy. You've written about it multiple times.
One of the main things I remember from my Econ 101 class was the utility rule, right? Your first slice of pizza is always the best slice of pizza, and the more pizza you have, the less you enjoy it. And it's because
diminishing
I don't know if I agree with that.
Right, the diminishing margin of returns. And they teach you that because everyone likes pizza, right?
Yes.
So if everyone likes Taylor Swift, maybe it's time to include her in class.
All right.
Diminishing Taylor.
All right, we're going to have to sign up for that class at the University of Kansas, guys. We're going to go take a look at that online. But coming up, we're going to bring you what to watch tomorrow. We're going to break down the stories you need to know to start your Wednesday.
Let's take a look at what is trending after hours. A lot of earnings reports here. We're watching shares of cosmetic maker e.l.f. Beauty, the company raising its full year guidance after beating estimates for earnings and sales in its third quarter. The shares up 5%. Enphase Energy also jumping after hours. Maker of solar equipment here, missing on revenue, but beating on earnings in its fourth quarter. The CEO saying that the first quarter of 2024 may be the bottom of the market, with the channel normalizing by the end of the second quarter. That's sending those shares up 16%. And tax preparer H&R Block reporting as well, up 1.1% or so. The company reaffirming its full year outlook after beating on revenue and earnings. And H&R Block also announcing its chief financial officer, Tony Bowen, is going to be retiring, stepping down in September of this year. And by the way, we're going to speak to H&R Block CEO Jeff Jones tomorrow on the program. Don't want to miss that.
And time now for What to Watch. Wednesday, February 7th, starting on the earnings front, Alibaba, Disney, Uber, CVS, and PayPal all reporting results tomorrow. Disney announced the earnings for the first quarter of 2024. After the bell, the battle for the board continuing to rage on, with activist investor Blackwell's Capital urging Disney shareholders to elect its 3 board candidates.
Moving over to the Fed, a couple of Federal Reserve presidents and governors speaking tomorrow. Susan Collins, Tom Barkin, Michelle Bowman, and Adriana Kugler all expected to speak as the markets continue to look at the Fed for more insight onto rate cuts, when they're happening, how many of them there will be. Fed Chair Jay Powell essentially taking a rate cut off the table for March last week after addressing the media and making an appearance on 60 Minutes. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a great night, everybody.